So I wanted to talk a little bit about a commonly held misconception in regards to the co-insurance clause, also known as a co-insurance penalty, um, which has caused a lot of confusion because not only are customers confused about it, many insurance agents are not clear on what's the better route for their customers. So basically, from a bird's eye view, the co-insurance clause is a clause that's attached onto property policies, which puts a requirement on the customer or the insured to maintain a level of coverage on their property at the time of a loss. Now, when you buy the policy, that precedes the loss typically. So you have no way of actually projecting accurately what the cost to rebuild your property will be at the time of the loss. And in times in a deflationary period, you don't need to really worry about it to the same extent that you would need to worry about it in an inflationary environment like we're in now. So for example, let's say last year somebody insured their building for $1 million and they had the standard co-insurance clause or co-insurance penalty of 80% on their policy. That policy requires the customer to insure that building up to 80% of the replacement cost at the time of the loss. So let's assume that the cost to replace the building has not increased. At inception it was $1 million, and today it's $1 million when there's a loss. So the policy requires, if it's the standard clause of 80%, that you insure it up to 80% of the $1 million, which would be 800,000. That's the requirement on the policy. If you don't, then a penalty is placed against you at the time of the loss. The penalty is what you had divided by what you should have had multiplied by your loss. So let's say, for example, you had an 80% co-insurance clause on your policy, and you have a $200,000 loss, and you have your $800,000 worth of coverage on your $1 million building. You're good. You've insured it to what you're required to insure it, the minimum level, and they just deduct your deductible and they pay you out. However, let's say you're in an inflationary period like we're in now, and now it costs $2 million to rebuild that building. So in that sort of scenario, you would be required to insure your building up to 80% of that $2 million, which would be $1.6 million. If you only had $800,000, even though your loss was only $200,000, so you only had $800,000 worth of coverage on your policy, what they would do is they would take what you had, which was $800,000, divided by what you should have had, which was $1.6 million, multiplied by your loss of $200,000, and they'd cut your coverage in half. $800,000 divided by $1.6 million is 50% times your loss less your deductible. Now, that's just how your co-insurance clause works. But for whatever reason, because of the environment that we're in the United States of America, everyone thinks bigger is better, more is better. So very often, agents believe that 90% co-insurance or 100% co-insurance is better than 80%. Terrible, terrible, terrible mistake. Essentially what that does is that puts the requirement in 100% co-insurance for you, the customer, to insure the building up to 100% of the full value at the time of the loss. And if you don't, the same penalty applies, and it's just exacerbated by an additional 20%. If you can, you want to acquire a policy that has agreed amount with no co-insurance clause. Replacement cost, special cause of loss with an agreed amount where you and the insurance company agree with what you're going to get in the event of a total loss, with no co-insurance penalty. But if you have no other option, you're in Florida, the marketplace will not bear a policy that has no co-insurance penalty, you definitely want to keep it at 80% and never more.